Episode 39. 1939 marked the official start of World War II. The sports world was saddened to hear Lou Gehrig was pulling out of baseball in 1939 after being diagnosed with ALS, and he was inducted into the Hall of Fame the very same year. Wayne Gretzky scored a remarkable 50 goals after just 39 games in the 1981-82 NHL season. Beyond MD, episode 39, here we go! Hey everyone, welcome back to the Beyond MD podcast on Groundhog Day. But the truth is, it doesn't really matter how long winter stays this year because my last DIY project, which is the backyard rink, worked out really well this year. The kids and I have already been on it several times this week. We have some very consistent winter weather finally, and we're creating some wonderful memories along the way, which is what it's all about. I want to take a quick minute here to thank the listeners. In the last month, I have received some very memorable emails and messages from listeners about the podcast, and I just want to say that I really appreciate your support, but even more importantly than that, I'm grateful for the chance to connect with you. I've told my wife time and time again that because of the podcast, I've made more friendships and more connections than at any point in my life after medical school, and it's a beautiful thing. And I hope that down the road, I'll get to meet some of you in person as well. So I just want you all to know that I truly appreciate you guys. So today's episode covers liquid alternative investments. And I did have one episode previously on alternatives, and that focused more on typical alternatives that can be illiquid, meaning that your money can be tied up for a certain period of time. But as I've learned more, and through some help from my guest, there are more liquid alternative investments being made available to investors. So these types of investments are typically funds that are managed, and they cover a wide range of sectors and asset classes such as energy, real estate, including real estate investment trusts, and private debt, just to name a few. And it turns out that several of these alternative investments are developing a track record for performing quite well in years when the equity markets are not. So why is that important? It brings up the concept of uncorrelated returns. In times of market stress, you probably don't want all components of your portfolio moving in the same direction. And I can tell you, money is a funny thing. After reflecting on my own experience and in talking to others, and it's taken me a good 5 years to just start to master my behavior around my investments, but I can tell you that the pain that comes with investment loss can often be much more intense than the joy that comes with investment gains. So I think for many investors out there, the concept of uncorrelated returns is an important one that can help us to stay the course for the long run. Now, one thing I do want to mention, as always, this podcast is about education only. There is not a sales pitch. But what I hope the content encourages you to do is to think critically, is to dive deep and continue learning about as many areas as you can in your life. And that includes medicine, finance, and beyond. I found that for myself, one of my core values, and I will talk about this in a future episode, is curiosity. It is my drive to remain curious every day of my life and to learn about as many things as possible. I feel that this makes life so much more rewarding. And if you're not doing this already, I encourage you to try and think along the same track. It's very, very gratifying. So now for my guest, Jeremy Donath. So Jeremy has a very interesting path. Jeremy first went on to earn his law degree from the University of Western Ontario, and he was called to the bar in July 2003. But after that, Jeremy spent over 15 years as an investment advisor and associate portfolio manager at a large national firm. And guys, this is yet another example of the path that you start on may not be the path that you end up on. Jeremy is married with 3 children. He loves sports, especially NFL football and NBA basketball. He is an avid connoisseur of Hollywood movies, and it is quite a challenge to find a movie that he has not yet seen. He loves traveling and fitness and has a deep-rooted family history of giving back to charitable programs and foundations such as Out of the Cold and Adam's Dream Fund at the Hospital for Sick Children. So Jeremy and his partner, John DiSabatino, have a practice that adheres to the mantra of invest beyond the ordinary, which involves customized solutions through both traditional and non-traditional investments. Jeremy wholeheartedly believes in going beyond standard investment advice for his clients. He also believes in adding value and educating clients to help them make the most informed decisions possible. Once becoming intimately familiar with client goals, Jeremy and his team then conduct vast amounts of due diligence, research, time, and focus beyond the ordinary to help achieve these goals. So I've had the pleasure of sitting down with Jeremy for 3 conversations before this podcast, and I picked his brain, I peppered him with questions, I challenged him on so many points, but he always had an answer. He's very knowledgeable, very well thought out, and he is passionate. And for people who are interested in reaching out to him, his email is in the show notes. And with that, here is my episode with Jeremy Donath. Jeremy, welcome to the podcast. Where does the podcast find you today?
I'm in the sunny region of Markham up here today. A little cold, but thanks, Katine, for having me on. I really appreciate it and looking forward to it.
Yeah, it's a pleasure. You're relaxed back from your vacation in St. Bart's. Sounds like you had a wonderful trip. And Jeremy, just before we dive into this, so people should understand our background. So I think a lot of the listeners of the pod know that I'm a keen sports fan, and so I'm fortunate to have the chance to go to a few Raptors games every year. And so I share seasons tickets. And the person who happens to sit next to me at each game is Jeremy Donath, who's the guest on the pod today. And so Jeremy and I have been to some momentous games. So we were together at Game 5 of the NBA Finals, Raptors and Warriors in 2019. Raps were up late in the game before Thompson and Curry just hosed us. And I remember that day vividly, Jeremy. Like I could tell leading up to that game from the games we had been at together. Like we never had talked finance, but I could sense your passion. Like you're a passionate guy. And I think on the way out of Game 5, I was trying to put a positive spin on things. And I said, listen, they're going to get the next one. And it was like the wrong thing to say because I think you wanted to punch me in the face as I walked out. So anyways, but we can't be at big games together as we have bad karma at games. There's fireworks. But I know today will be different. So
yes, for sure. I know we said we might give it one more chance. And if we lose another big one, then we're going to pass our tickets on to someone else.
Yeah. I'll give you a heads up when I'm going to a big game. And so, I mean, I can probably sell mine or one of us can decide not to come. But Jeremy, tell us now a little bit. I know your passion spills over to finance. So tell us a bit about yourself, what you do and your experience.
Yeah, sure. So I've been in the business now for just under 20 years with my partner. We run the Donath and DiSabatino Wealth Management Group here at BMO Private Wealth. I was at another financial institution for the first 17 and a half or so years of my career. But prior to that, I was a corporate lawyer. So that was my first career. Very briefly practiced. And as I like to tell my friends, clients, and family, I decided to turn my passion, my true passion at the time, into my job because I'm a big believer in doing what you love. And I wanted to spend a lot of my days working, doing something I was interested in. So here I am 20 years later and running my business with my partner and very happy and glad I made the decision to do so.
That's wonderful to hear. And from the conversations we've had, I can tell that you truly enjoy this material. And so diving into the content now, so we all follow some greats. We all follow Warren Buffett, and he has a lot of famous one-liners. And I know one of his one-liners, which maybe isn't discussed as much, is never lose money. And talking to you, I sense that may be part of the approach that you adopt. So maybe just talk to us about your approach when it comes to investing and managing portfolios.
Sure. And then when it comes to not losing money, I'll focus on that. There are other aspects to obviously our strategy, but I'll hone in there. Returns over a long period of time are what they are, and everybody and every client is going to end up with different sets of returns depending on who you work with and whatnot, and what type of portfolio you have and what your strategy is. At the end of the day, our belief is that generally speaking, most of the time, up markets have a knack of taking care of themselves. Everybody, again, having a different strategy, you can generally capture a fairly decent chunk of the upside, whether that's holding indexes or mutual funds or stocks or bonds. Generally speaking, you are going to capture the upside. Where people look back at their investing career or life and say, I didn't achieve what I wanted to, is because of how they performed on the downside. And it is the downside that has a tendency to very much interrupt people's plans and strategies and goals and desires and dreams. That is the that is the number one problem with portfolios, is that losing money in those down years is the destructor of people's goals and wealth creation. So we decided, a number of years ago that we would place a large focus of our practice on that facet of the business, understanding that the other side is obviously as important, but focusing on the downside generally, when looking back at all of the data, would allow things to more take care of itself rather than focusing on the other way around, which is what a lot of people do, which is trying to make as much money in good times and then finding themselves in a sort of precarious situation when things get bad.
And now let's segue into the topic at hand today, which is liquid alternatives. And from our conversations, I sense that liquid alternatives probably do play a fairly key role in what you do. So maybe just give us a basic overview to start, and then I can pick away with some more detailed questions. But what are liquid alternatives?
And liquid alternatives specifically are a major part of our portfolio, as we've discussed. Liquid alternatives are a way to invest in certain asset classes, and I'll focus on both words as separate entities. So liquid alternatives, the word liquid means that they can be bought and sold on a daily or weekly or monthly or quarterly basis. There are some that are longer, but the general feeling out there, or one of the myths of the sector or space, is that they're not liquid and you can't get out of them and you're stuck in them for a long time, or when you need your money back you can't get it. That is the opposite of the way it is. There are a number of these positions that actually do let you buy or sell on a daily or weekly or monthly basis. And then the alternative part is simply exactly what the word means: an alternative to equity, an alternative to fixed income, a non-correlated alternative to fixed income or equity, and in some cases that can be bought and sold in small time periods. Most importantly, having a negative correlation to the market.
Okay, so that's important. So to basically fulfill this criteria of being a liquid alt, there has to be a negative correlation to the market. That's helpful. Now, what sectors or what asset classes do these funds, if I can call them, these liquid alt funds, tend to focus on?
A large variety, actually, growing every month, quarter, year. And that's the nice part, is that there's always some new and interesting ones that come up. There's only so many stocks and bonds and things like that go into typical portfolios, but the liquid alt sector is growing all the time. So generally speaking, you have sectors that are in real estate. You have what are called merger arbitrage. You can have long short. You can have absolute return. You can have private equity, private debt. There are just a number of growing, and even within like sectors like real estate, there are just so many. You could have direct access to apartment buildings, low rise, office towers, global real estate in Europe, Asia. So there is no shortage of menu items. It's just a question of which ones fit most closely with the client's needs and goals.
Jeremy, can individuals themselves access these funds, or does this typically have to be done through an institution?
The majority of these funds can be accessed on their own in terms of investors accessing them on their own, but also a fair number of them are only available at the what I would call brokerage level. So funds that you could only access through places like us or other entities like us. Some of the companies do make it a point of only accessing companies like ourselves because they want to reach a certain type of investor with a certain type of wealth. And there are a number of those as well that are available to either call it high net worth or ultra high net worth, that they sort of keep off the regular channels.
A lot of people listening to the podcast are investing in RRSPs. Are these funds typically RRSP eligible?
They are. There are very, very few which are not. And even the ones which are not, they are always looking to figure out how to get added to the lineup of RSP eligibility. It actually doesn't take a lot. It really just depends in some cases on what type of corporation the fund is, but in 95% of cases, they are all RSP and TFSA eligible.
You were very kind to send me over a few fact sheets just for my own learning, just for my own investigation. And one thing I tried to do was go back in time to see how long have these funds been around for. And I sense that with time, the number of funds is growing. But Jeremy, maybe you can talk us through kind of your process. What do you kind of look for to decide whether a liquid alternative fund is truly investable? Can you take us through a basic checklist that you go through as a part of your own due diligence process?
Yeah, and that's a great question, because the largest element of why and how one of these would end up in a portfolio is the due diligence process. Because like any other entity, stock, fund, ETF, there are tons of them, right? And we're trying to decipher the ones which are okay from not so okay to bad to good to really good. And we want to end up where possible with as many really good ones which are, again, not correlated to each other. So we have a checklist. We actually do have a real checklist. And my team has a very hard fastened rule that if it does not fulfill all the check marks, it is not going in the portfolio. So there are about 3 to 5. The most important one is, how has the fund or the liquid alternative performed in down years? We don't even look at the up years. I mean, I shouldn't say that. We do. We just expect that the up years at least produce a decent element of upside. Otherwise, of course, we're not going to buy it. But we go right to the down years. And so in the last 10 to 15 years, of course, where the fund has been around that long, there has unfortunately been a number of years for us to look at, whether it goes as far back as 08, 2011, 15, 2018, 2020, and as recently as this year, 2022. That's a number of years to look at. So we're looking for a consistent performance in down markets, of which there unfortunately have been many. We are also looking within each calendar year, how is the performance and what is the fund doing on a month-to-month basis? So what I mean is just because a fund shows that at the end of the year it produced a good return, but the question is how did it get there? Did it go up 10, down 10, up 10, down 10? Or did it basically have we're looking to see if within those periods, COVID of 2020 being a great example of, specifically in 2020, how did it perform in February, March, and April? So if it passes that test, then it at least enters the conversation. From there, the second most important criteria is getting to understand at a very, very granular level and detailed level, what is the manager doing to produce these returns? So we conduct multiple due diligence meetings with the managers. We speak to them multiple times when we want to know exactly what they're doing to produce both the upside and the downside returns. And what we're looking for more specifically when we talk to them is the consistency. So if in 4 different, call it bear markets, they produced their downside protection in 4 completely different ways, we don't like that. We want to see someone who is doing the same thing over and over again every time in order to fulfill that extra alpha for the portfolio. I don't want to hear, oh, I was really good at going to cash that year, or I picked the right stocks. No, we don't like that, because that's not a repeatable strategy. So it's repeatable and consistency and downside protection with reasonable limits on that volatility. The last one is, does the fund access markets that we cannot access ourselves? Right. So, at our level, it is obviously more difficult to access things like direct global real estate or private credit. We have to be able to the fund has to have value. And if it's accessing a market or an asset class that we can't get ourselves, then that's a really good thing as well. And it has to be in an asset class which doesn't generally provide blow-ups from time to time. So while I'm not going to use words like always and never,
Mm-hmm.
my team and my partner rarely look at alternative sectors that have had problems in the past, like private credit
Mm-hmm.
and
Yeah.
loans. And there's just enough out there that we don't have to look at all of them. And so that those are the big three.
Okay, perfect. Really helpful. So, in terms of these funds are being actively managed, right? So it sounds like
Mhm.
your second checklist, you spend a lot of time investigating what are the managers doing to generate returns, especially in the down years. And my sense, and maybe this year casts some doubt on what I'm about to say. My sense is that a lot of the time, active management hasn't panned out, but I think maybe this year there's been maybe a bit of a shift in thinking. But what I want to ask you, Jeremy, is how many funds do you kind of have to go through to finally fulfill those three check boxes? Like is it, do you go through a ton and then arrive at maybe a select few, or are these diamonds in the rough maybe more common than we think? I just want to get a sense of how you kind of, how long does it take you to come to your final list?
We look at each fund on a case by case basis, and we look
Mm-hmm.
at it relative to how many we're holding in the portfolio at one time, how many we
Mm-hmm.
want to be holding, and in what percentage weighting. So, for instance, with this year being a bad year, we have expanded our alternative holdings, and as a result, there's more room for extra people at the party. If we move back into a market where things are trending positively for common equity, then maybe we close the doors and make it a little bit more of an exclusive party. But on a one-off basis, on a case-by-case basis, if we are looking at all of those check boxes and the fund satisfies those criteria, we don't always put it in the portfolio right away because maybe it overlaps with another fund that does something similar. Maybe it doesn't exactly have as much of a track record as we would like. But if it does make it into the portfolio, very often it is kicking something else out as opposed to just us continuously adding new ones all the time because you don't want to let your alternative portfolio get into a situation where you're holding 15 or 20 funds because you then lose that ability to have diversification within diversification.
I think you already kind of touched on this, even spanning the last decade. There were a number of years where the markets maybe went down. And if we go back even further in history, so I think, correct me if I'm wrong, but probably from about 1999, 2000 until maybe 2010, 2011, even, there was probably not much. If you had started investing in 2000 at the peak, you probably didn't make any money for 12 years, right? So I guess you go through stretches where maybe the markets aren't making anything. So is it safe to say that you're trying to smoothen the ride during those turbulent times?
Exactly. So the reason for holding alternatives in your portfolio, aside from the big picture reasons to have it as an asset class that just has worked for a long time, is it is there for two major reasons, which are sort of opposites of each other. So the first one you've touched on is that they're there so that in those periods of volatility or longer periods where markets, are flat or don't do that much, they are there to offer returns to people. So, we all know that until recently, obviously yields have gone up now, but you were hard pressed to find returns from the bond market for many years, at least in terms of coupons. There were capital gains to be made, but for those seeking income only, it was pretty tough. So, in periods of time where markets go down or are flat, yes, you have a proven track record of these assets producing very, very solid returns. It's not just even in broader markets. I've been in the business for long enough that I've come across, I don't know how many exactly, but I've come across a number of people who I meet and they have an entire portfolio of bank stocks. And, of course, they say, well, these are great companies. And they are. They're great companies. No one would doubt that for a second. But even bank stocks have 5-6 year periods where they don't depreciate and they make their dividend payments, but the return is not, fantastic from a capital appreciation perspective. Um, a way to make money in those time periods. The opposite of that is that when markets do go down and do fall and do have double-digit negative periods, it gives you an opportunity to alter your asset allocation and take those assets, which have hopefully produced positive returns, and now potentially alter your strategy and use those funds to take advantage of those falling and lower markets, not to sell something that is in a losing position to buy something else that is in a losing position.
Some people may challenge the notion of liquid alts by saying, well, instead of investing in a liquid alt, why don't I invest in a so-called true alt, like directly into cell phone towers or farmland? Because investing in these true alternatives allows me to benefit from the so-called illiquidity premium. I've talked to people and this is what they tell me. So I want to pose this to you. How do you react to that?
I react to that actually in a very similar way to people who have come to me for the last 20 years and say, well, real estate is the way to make money. Why would I buy X or Y? And my answer is, why not have a little bit of everything? You want to buy the cell phone tower and the farmland as a piece of your wealth? Go ahead. You should. But so I'm not a proponent that the only thing in the world people should have in their portfolio is what I offer. We luckily do deal mostly with people who have an ability to, obtain a growing wealth profile, or who already have obtained it. And I'll be the first one to tell you that if someone has the room in their portfolio for those types of assets, they should absolutely own them as a piece of their portfolio. So I'm not the advisor, and my partner is not the advisor who tries to push people away from good ideas. We say, yeah, you should have all good ideas in your portfolio. We just think you should limit them to a certain percentage, like anything in life.
Can you speak to returns of some of these liquid alts and compare them to returns of the TSX and the S&P 500, just kind of broadly speaking, over the last
Sure.
10, 12 years?
So there is no, say, liquid alternative index per se. There are some hedge fund indexes, but those do really include such a wide array of assets that they're not a true comparison. I look at our strategy, and the good news is we've actually done this. So we created basically a list of most of the alternatives that we use or have used, and we've benchmarked it against a typical Canadian investor's portfolio. Now, the difference with ours is that, yes, we've put together a 60-40 model, but it's not just a 60-40 model of stocks and bonds. The equity portfolio is made up of Canadian, US, and international names, and the fixed income portion is made up of different types of bonds, preferred shares, and cash. We did that because we believe that gives a more accurate picture of what the average Canadian investor's portfolio looks like. Very rarely do I meet a person with a portfolio who has fixed income of nothing but bonds. We see a lot of preferred shares, GICs, cash, so a little more appropriate to do it that way. Generally speaking, over the last 10 years, we looked at the alternative platform and against some of the more well-known benchmarks in North America, especially the TSX. The returns are significant. I can go into the details of what those numbers are, but I'll say it's middle single digits in terms of the per annum difference in a positive manner. Imagine making, single digit returns over and above what you're making every year for the last 10 years. I will say the S&P would have produced a better outcome against our alternative platform for the last 10 years. And that's obviously, the S&P has performed significantly better than the TSX for the last 10 years. It's not a surprise. The only thing we do tend to warn clients about, when using that example, is probably the idea that we're going through right now is the opposite side of that coin, which is the S&P for 10 years did do quite well. However, a lot of the reasons for that were on the backs of a very small number of thinly based, lack of breadth. It was about 10 to 15 well-known companies on the tech side that carried the index. And now I think this year we're starting to see the other side of that coin and what can happen if that unravels a bit.
This segues nicely into my next question. So I'm going to challenge myself from earlier in the talk, and I'll try and gently challenge what you just said. This is just for thorough discussion.
Sure.
But I guess the reason we try to index, so a lot of people, myself included, we invest in index funds. And so the reason we index is that we know, generally speaking, there are going to be maybe a handful of companies that are probably going to carry the market. That's what's been happening for the last 10 years or so. And it's really hard to go out and pick those companies individually. And now the dynamic has shifted and there may be a new batch of companies. I know I myself, I'm not going to be able to pick them. So I choose to index. And I know that I said from 2000 till at least just past 2010, if you invested at the peak, you indexed, you probably didn't really make any money. But then when I go back in time, and I look at rolling 10-year periods from 1937 to now, about 85 to 90% of those 10-year stretches are in the positives if you invest in the index. So I guess the proponents of indexing may come with that argument and say, listen, if we have a long-term horizon, why not just stick to indexing? Maybe I'll throw that at you. And
yeah,
how
of
do you
course.
respond to that?
And
Yeah.
it's a common theme that we hear all the time. And
Yeah.
I guess there's two answers. There's the short one and the slightly longer than short one. So the short,
we have time. We have time.
Yeah. The shorter answer is very similar to what I just mentioned previously when you asked me what do we tell people who say they like cell phone towers and farmland, and the first and shorter answer is you can it's not a black and white, it's a gray. You can have both. You can and should do both. We don't tell people alternatives should be 100% of their portfolio. The largest pension funds that we know in the world don't have 100% of their portfolio in alternatives. So understanding that, you can totally have elements of S&P or MSCI World Index or TSX in your portfolio, as long as there's an understanding that when markets do go down or are flat, that is the part of your portfolio which you can count on the least to protect you. So the way we look at it, and this sort of segues into the longer answer, and I guess for you and your audience, I'll maybe use an analogy which isn't perfect, but hopefully it makes sense. You have a patient and you can say, okay, this person has been my patient for 40 years. And generally for the last 40 years, that's a healthy person. She is a healthy person, and they're doing well. But over that 40-year period, they still got sick. They still got really sick. They still had health problems. The question you would ask yourself is, if I could eliminate those periods of that person's life where they were sick or not well, would I? And the answer is, of course you would. So it's the same thing in my business. Index returns will produce generally healthy results over long periods of time. But what we're here to do is to say, in all of those periods when markets do fall, and I just named about 6 of them in the last 20 years, so they come along very often, we're here to sort of say, okay, when that's happening, let's try to prevent the sickness. Let's try to keep you healthy in those bad years. And so what that looks like in portfolio terms is, in the periods where you're making money and the markets are doing well, you're building profit on profit, and the returns become way larger and way more exacerbated than just index returns. And as you know, it doesn't take a large number above index returns to produce a significant amount of wealth, especially when you're compounding later in life. Even 3 or 4% over 40 years is a massive difference maker. So we're not here to, we're not proponents of never owning index style investing, but rather to, take those periods of time when things don't go well and give you a chance to spend the least amount of time or very little time being, so to speak, ill or sick. Let's be healthy the whole time, not just at the beginning and the end without paying attention to what's going on in the middle.
Jeremy, from the sounds of it, right now we're going through a rough patch in the market. So I sense that right now your strategy may involve more of these liquid alternatives. But I suppose there will come a time when maybe you may decide to pivot a little bit more aggressively to equities. This may or may not be true, but let's say you do change your posture, your stance a little bit. I guess the decision as to when to do that, doesn't that involve some element of market timing, which we know that over the course of history, and we know that the more we try and do it, and over the longer term, this becomes harder and harder to do. Like, isn't there an element of market timing as to figuring out what posture you're going to take? Talk to us about that.
Yeah, and that's a good point, and I would expect that to be an argument that someone or that someone would make, and it's a valid point. I think where we want to be clear is we're not going from very little to a lot or a lot to a little, because alternatives, in our opinion, based on the way we feel about them over long periods of time, should always be a fairly decent component of your portfolio. So when we're talking about shifts in market sentiment, I'm not taking alternatives, down from 50% to 5. I might be, over the course of an entire market cycle, maybe taking it from 20 up to 35 or 40 per se, and that means a shift in equity from, like I said, 20 or 25% upwards or downwards. I can do that and still produce really, really good returns for clients, because the alternatives are not there to only do well when markets are bad. They also do extremely well when markets are good. And even in some good years, they do beat the market. So as long as they do well in good markets, that's more of an assumption. When the markets are bad, if they're also doing well, and I want to shift back to equity, I don't have to go from 0 to 60 in 5 seconds. So it's not as big as a shift as one may seem. It's more of a shift from a regular weighting in alts to a larger one back to a regular one.
You mentioned pension plans, and a lot of us also like to keep an eye on major pension plans and how they're investing. So currently, what is the status of pension plans and their focus on liquid alternatives or alternatives in general?
Yeah, that's a good question, and I think it's something that people should be paying more attention to, because at the end of the day, even though pension funds still have their blips and errors, they are, so to speak, the best money managers in the world. And the history and the facts prove that. And so, years ago, they had very little to none. But if you look at, small, medium-sized, large pension funds, endowment funds, you're looking right now, depending on what type of pension fund, large pension funds are holding, around 35% of their portfolio in alts. Small pension funds are over 40. And then you have some medium-sized ones, that are in the 25 to 28% range. Some endowment funds, even in the United States, that are very well known, have gone as high as 70 to 75.
Wow.
So the way we look at it, and one of the mantras we speak to at every new meeting with a new potential client is, now that you have the ability to invest like a pension fund, why wouldn't we do this? Why wouldn't you want to have the same strategy as the best money managers in the world that have proven time and again to have been able to withstand market volatility better than any regular investor? So that's why we sort of start with a 20 to 25% weighting, because that's typically the lowest weighting you see from a pension fund today.
Let's dive into some information we may encounter on a fact sheet. Let's say I become interested or somebody else becomes interested. They pick up a fact sheet for a fund. They may come across a lot of terminology there. And one thing that's sometimes thrown at us is the fee structure of a fund is a 2 and 20. And I may have this reversed, but what does that mean when I hear numbers like that?
Sure. So what those numbers mean is, the first number is the 2 is the ongoing annual cost or fee for the company to manage the fund for you. And that is typically going to stay stagnant. That doesn't change. The 20% or the 20 number is indicative of the percentage of returns that the company will share with the investor usually beyond other statistical features of the fund, such as what's called a hurdle rate or a high water mark. Without going into, for the moment, what those two are, if we achieve those hurdle rate and high water marks, they're saying anything beyond that achievement, we are going to share the returns 20% to us and 80% to you.
And now the hurdle rate, though, is that basically the rate of return that goes entirely to the investor? And beyond
Correct.
that, that's where the performance fees come in?
So just like you would think it means, the hurdle rate is the percentage, and always positive, of course. The percentage hurdle rate is the rate of return from a positive perspective that the fund has to achieve, which goes all to the investor before we start looking at performance fees. So that number can range anywhere from a specific number to, say, a specific percentage above index returns. So some of them are a moving target and some of them are a stagnant target.
So 20% at first glance to some people can seem like a large number. I know where we're taught to reduce fees or minimize fees where we can. 20% seems like a high number. Why or why not should I care so much about that number? Maybe just talk to us a bit about that.
Sure. And yes, it does seem like a high number. Where we encourage investors to not care, but understand the fee structure better so that they know why they're paying it, is because that 20% shared return is one of the only times in life where the investor has to share, or where anyone has to share a return or a cost, where they're only achieving a positive result. So we all know in other aspects of life, you still have to pay for your services, even if you don't necessarily get what you wanted. You can't exactly not pay your bills just because you didn't get the desired result, right? Whereas here, you're not sharing that 20% with the company unless they achieve their desired result. And again, if I had a quarter for every time I heard a client say, I have no problem paying costs and fees if I'm getting what I'm supposed to be. And in the same breath, if you talk to them about performance fees, they're like, whoa, those are scary. But it's like, it's actually what you just said. You only pay fees and you only share the cost or the results rather with the fund if they achieve a positive return. I think it would be just really quickly important to understand what these terms. We discussed hurdle rate, but the high water mark is the bigger one where people will understand more. The high water mark, it's not just the hurdle rate. They have to achieve what's called a high water mark. And the high water mark is basically a way of describing that the fund cannot collect a performance fee unless the fund is trading at the highest level it's ever been at. So imagine you can only collect a performance fee if first you achieve a minimum rate of return, and then for the company to continuously keep collecting their portion of the split between you and the investor and the fund company's net asset value has to be consistently and always trading at an all-time high. So when I put it to investors like that, they're kind of like, oh, well, okay, like I'll do that, but
Right.
It's not really explained well when you just hear things like alternatives have high fees. So, it's one, like I said, I'll end where I started. It's one of the only places in life you can actually pay for what you get. And this year being a bad year, you can be rest assured nobody's paying performance fees this year.
Right. Fair enough. Now, what if somebody holds a certain alternative fund and then sells that fund or gets rid of it in a certain time frame? Can there be a fee on the back end for selling that? Does that come up at all?
It does. And again, this is a case by case. Some have none of those features. Others
Okay.
do. It is number one, it is incumbent on the advisor to explain to their client that if there is
Yeah.
a minimum holding period, that there should be an explanation to the client as to why there is one, and that there is one. And the second
Okay.
part is those types of funds generally that have some type of a charge to get out within a specific time period are doing so because the investments are in an asset class that are not easily liquidated, and
Mhm.
really try to ensure that if the investors are getting involved in a certain type of strategy, that they're doing so with a more long-term view in mind. Because, for instance, in a real estate portfolio, it's not so easy just to sell buildings if people want to liquidate.
Now, kind of getting to the end. So, in a few more terms that I see: upside capture, downside capture. Is that pretty self-explanatory? Is that basically on a good year for the markets? Well, how much of the upside is captured by the funds, and then vice versa? Kind of how much of the downside these funds tend to replicate? Am I understanding that correctly?
So it is, but it's the opposite in terms of upside capture. You're 100% right. So if I said a
Yeah.
fund has an upside capture of 90%, that generally means, again, that a fund is going to capture 90% of the market's upside.
Okay.
Now, if I say that the fund has a 90% downside capture, it also means that the fund is going to capture 90% of the market's downside. So what you're
Mhm.
looking for with alternatives is a negative downside capture
Gotcha.
number. So when
Gotcha.
you see
That's really
things like minus 10, that's
yeah.
amazing because they're making money in a bad market.
Okay. Gotcha. Last thing about the fact sheets is the Sharpe ratio. Like, what do we need to know about the Sharpe ratio?
The Sharpe ratio is a term that
Or
is
is it
also
even important?
typically
If it's important.
uh, so it is actually going back to one of your
Yeah.
earlier questions. It is a checkbox that we will use on a smaller scale. In fact, the Sharpe ratio is the generally accepted one, or value that is placed on these fact sheets. We like that one, but we also like more what's called the sortino ratio, and I'll explain
Oh,
briefly
okay.
why.
Yeah. Yeah.
The Sharpe ratio measures volatility in a fund. So the problem with, or one of the downsides of Sharpe ratio, is that it measures volatility on the upside and the downside.
Hmm.
So if a fund has a really good Sharpe ratio, that also means though that it it can actually have too much volatility in either direction. So why we actually always ask for and like the sortino ratio, which I know is a little bit of a technical jargon term, but it helps your listeners understand that the sortino ratio is the most important sort of fancy technical term, is because the sortino ratio specifically captures the downside of the fund. It eliminates the upside and just shows you how well the fund performs in down periods. And again, as you can tell through this conversation, that's the one that's more important to us.
So, Jeremy, those are my questions, but I want to give you a chance to cover anything we may have missed or anything else that you want to share.
I would say, in general, again, just going back to a big picture theme, there are a lot of people out there starting to talk about alternatives, but I would say on the whole, it is still a very, very underutilized, underappreciated asset class that I still am somewhat surprised to see completely void of in most people's portfolios. A lot of equities, a lot of fixed income and cash. But I think that since the financial sector has done a really good job of opening up these doors to the public and
Mhm.
giving them the opportunity, I really do hope that on the whole, in terms of the idea of just helping people and making their financial lives better, that I hope to see a lot more advisors and investors using these in their structure, just to sort of, whatever can help the general public is going to be a good thing for all of us. And more of these in terms of an understanding of an allocation relative to what people consider the smart money out there would be a really nice thing to see. I'd like to see more people using more of them on a day-to-day basis.
Jeremy, I want to thank you for taking the time to join me. You know, I've really enjoyed our conversations, kind of off the record. Been learning a lot. We'll continue to talk finance, just not at any playoff games together. But yeah, but no, hopefully we can watch a game together. And you know, if I'm just talking your ear off, you got to let me know. I'll let you focus on the court as well. But thanks for taking the time.
No, thank
Yeah.
you. Maybe we'll go to a preseason game.
Yeah, that's right.
But I do appreciate it, and something that you've always mentioned to me as we've chatted is, you know, you can, if there's one thing you can tell, is I'm very passionate about this space. I'm looking to help people, and there's a lot of good strategies out there. This is one of them, and I just would like more people to open their minds up to it. And I really appreciate podcasts like yours that give people an open forum to hear about, you know, educating themselves and bettering their situations.
Hey, thanks so much for that, Jeremy. Appreciate that, and take care. Okay.
No problem. Thank you.
All right, guys, that's a wrap for today. I hope you enjoyed the material. You can reach out to me at beyondmdpodcast@gmail.com or follow me on social media. And again, connect for topic suggestions, feedback, anything. It's always my pleasure to connect with the listeners. So until next time, stay well, stay curious, and stay savvy.